Hi guys, David Jennings here from the Online Trading Mastermind, and I'm really excited today because I've lined up a call with Justine Pollard. Now, for those of you who've been a subscriber with me for some time, you remember it's been well over 12 months since we last had a webinar with Justine, and a lot is going on in the market right now. I think she's been more in demand over the past 12 months than she's ever been, and I think partly because her trading methods, they're just so effective regardless of what the market conditions are doing. And we're going to learn a little bit more about that in tonight's webinar, like analysing, well, where is the market now, what conditions do we have, and that can help sort of dictate the type and style of trading that we do. I think now the type of market conditions we've got, we're really at a point where we're finding that we're sorting those who have trading plans from those who don't. It's kind of like sorting the men from the boys, so to speak. And I think now is the time to start asking yourself, do you have a trading plan in place? And if you don't, I definitely think now is the time you need to start thinking about it and taking steps. While everybody's sort of not too sure what to do, if you start to get these important trading components in place when the market does turn around, and we'll see as Justine takes us through some of the market conditions and the way markets sort of move over time, you'll be well positioned to take advantage when the market does turn around. So I'm not too sure how long you've been a subscriber for the Online Trading Mastermind and what I do online, so I thought maybe it's best off, first of all, I'll just give a real super introduction to Justine just so you can find out who she is. She's a mum with 2 children. She's a private trader, a mentor. She's also written the book Smart Trading Plans, which has been extremely popular, and it just details what it is that you need to do when designing trading plans that work. She's also been included in numerous books that you can see written on there, and if you want to find out more about Justine, you can obviously head over to her website, smarttrading.com.au. But without further ado, I'll just invite you to the line. Justine, are you there?
I certainly am, David. Great to talk with you again and connect.
Yeah, it's been a long time, so I appreciate the time. I'm interested to find out, what have you been working on over the past 12, 18 months since we last had one of these webinars?
Well, before I do get started, I just need to put my disclaimer on the screen, and that's just to remind everybody that I'm only licensed to give general advice. I'm not licensed to give any form of personal advice. So what my goal here is basically to illustrate how I trade the stock market. Nothing that I'm showing you can be taken as advice, and it's all for illustrative purposes. So I'll just leave that on the screen for a couple more seconds, and then we'll delve into what I've been up to.
Yeah. I think as people are reading that as well, I think you're going to be really excited by what you see in this presentation, because I think Justine just shows real world trading examples, and you'll see this presentation, it's live, like right up to the minute. She's just before we had this call, she was updating the charts to make sure we've got the most recent information, which is great.
And that's because there's been so much action of late in the market. That's for sure. Okay, so what's been happening with me the last 18 months? Well, I've definitely been in demand. I've been speaking at a range of events throughout Australia, at the Australian Investors Association conferences. I've got one coming up with the Australian Technical Analysis Association. Had some media, had a great write-up in the Sun Herald last week about, especially with the current market and what's happening and what traders need to know. And there was also a fantastic interview with one of my clients in there and how he's applying my strategies. And one of my goals is to continue to support my clients, and part of the Online Trading Mastermind with the group that kicked off a year ago, everybody became a part of my mastermind community, and that involves quarterly webinars and a discussion forum. And so each quarter I talk about topical information that's happening out there and any changes that I've made to my trading plan. So some of the key things, or the key topics that we've covered, was how to trade sideways markets, because some of the markets around the world, and especially in Australia, have been in a long-term sideways period. So what sort of things can you do differently? And discussing an aggressive exit strategy that I bought in last year, as part of my trading plan. Because Australia had predominantly been in a sideways market, the big returns weren't out there. The market wasn't trending upwards or downwards, so you weren't getting the larger returns. So you needed to basically make sure that you capped your profit potential as much as you could. So anything that, if I make any changes, which I rarely do, it's probably been over the last year I've made those few tweaks to my trading plan with the aggressive exit strategy, and providing some ideas for clients as to how they continue to handle the current market conditions with my trading systems. And what I want to do in this webinar today is also cover a few things. So I want to go through the current market. And before I do that is actually talk about how I view the market, so that you can understand from a charting point of view, because I use technical analysis for everything, so you can understand from a charting point of view how I read the markets. And then we'll have a look at the charts of the Australian and the US market indices and what they're telling us. And then I want to go through and talk about market exposure guidelines, which should be a key part of your trading plan. And it's only when certain things in the market happen, like what is happening out there, that if you don't have a plan for that, you realise where you're lacking in your trading. And it's so important to consider everything that can happen in the market and how you're going to trade the different trends and scenarios that can play out. And then I'm going to share some current trades, especially in this volatile market. I have been taking some short, sharp trades, more volatility play trades than trending trades. I will cover more of my trending and breakout trades in another webinar, because I'd like to share a bit more detail on that as well. And then I'm sure David's got some questions he'd like to run past me as well.
Always. Sounds good. Well, let's get into it.
Okay, so let's first have a look at how I view the market. So I believe the market has 4 market stages, and this is a summary of the 4 market stages. The first one is the stage 1 basing pattern, and this is where the share or the stock or the index is going sideways predominantly. And at some stage it will break out of that basing pattern, and if it breaks upwards, because it will be trading between a support and resistance line, it will be moving into a stage 2 uptrend. And this is the healthy part of the market. This is where you're going to make the big money in the market. 2003 to 2007 in the Australian market, we had that uptrend. Then it topped, and that's where you have your stage 3 top pattern that occurs after a long-term uptrend. And then usually after a top phase, we start the stage 4 downtrend, and that was the GFC. And that's what we saw happen during the GFC. And then usually after a long-term downtrend, we move back into that basing pattern. And you can see these stages repeat again. Sometimes they don't go in this exact order. They may go into an advancing stage, look like they build into a top, and then lo and behold, they break upwards again. So to have a look visually at the 4 market stages, this is probably the best way to view them. And what I have on the screen here is a weekly chart with a 30-week moving average. So whenever I look at weekly charts, I always have a 30-week moving average, and depending on what that moving average is doing with the price activity determines what market stage it's in. So when the market is going sideways and that moving average line is fairly flat and the market zigzagging above and below it, that's when you have a sideways phase. And especially if the market's had a long-term downtrend and this occurs, that would then be classed as your base. And that's what we have at the start of this chart. Then once the market breaks up and starts making higher highs and higher lows, and that moving average line is rising and the share price is above it, that's your stage 2 uptrend. And that's what you're seeing in the next part of the chart. And that's the healthy part of the market. And that could go on for a few years. You just never know how long things are going to last for, but while they're going, you want to keep trading in that direction predominantly. And then after a stage 2 uptrend, the market at some stage will reach a certain high point, and that's where it will top out. The market will only rise so far before people, as soon as the buyers start to dissipate and you have more sellers coming in, that's when you're going to get a top phase occurring. So there comes a stage where people become uncomfortable buying. Maybe the market's becoming overpriced. Maybe certain economic conditions are occurring to cause that to happen. But from a charting point of view, the market will now stop making higher highs, and it may start to make equal highs. And then it may build up a support and a resistance zone. But if it breaks through that support line and that moving average curls over and the prices are trading below it, because I've got candlesticks on this chart, so I use candlestick charting. But once the prices fall below that moving average line and are trading below it and that line is falling, that's your stage 4 downtrend. And that's what we have in here, a stage 4 downtrend. And that's an unhealthy part of the market. And in order to profit during this stage, you need to be short selling. If you don't short sell and you're only a trader on the long side, which means you're purely just a buyer, then that's the sort of market you want to sit out of. So I do have 2 trading systems. One of them is a long only system, a weekly long-term system. And so when I hit markets like this, where the market is falling, and this is what happened in the GFC, once my exits are hit on any of my long trades, I'm out of the market. And I sat out of the market for 1.5 years with my long-term weekly system. But I have another system, which is my daily swing trading system, which is more active, and it actively short sold during the GFC. So anytime there's a stage 4 downtrend, I'll be actively short selling in the market. Then after a stage 4 downtrend, the market will hit bottom prices, and this is where it will start to move sideways again. And it gets to low points where people are then comfortable buying again. The market's become undervalued and they want to start buying. So you start to get an accumulation phase, and the market will start to go sideways between some form of support and resistance. Sometimes it might be a powerful uptrend that starts, other times it might just trend sideways for a period of time. And that's when the moving average line will flatten out and the price activity will zigzag above and below that moving average line.
Quick question on that,
representation,
Justine.
Stages.
Some really good insight there as far as what the market's doing. And you talked about this idea of having 2 trading systems. How do you know? Like, are you doing analysis on the index or something like that to determine whether or not, okay, well, my long trading system, I'm going to turn that off because I'm in a stage 3. A stage 4 downtrend market, and is that the point at which then you pull it out, or do you just let, once those exits start hitting, obviously the long trading system is going to stop firing buy signals, so that's going to be what keeps you out? Is it the system not giving the signals, or is it you doing some analysis of the actual market conditions?
Both happening, really.
Okay.
With the GFC, my exits started to get hit end of 2007, and then the last one went in January 2008. And as part of my weekly routine, I look at all the index charts of the Australian market, the US markets, and the other world markets. And I'm always looking at, well, what market stage are they currently in? And that's the direction I want to be predominantly trading in. But my scans, because I run my systems are all computerized in Metastock, so when I run my scans, I was also getting no signals with that long-term system. Nothing was making new highs anymore, so there was no signals coming up at all, which is also a sign for me to consider, well, obviously there's a change in the market, and really hone in on the indices and what's happening in the market, and have we changed direction with the trend.
Yeah, cool.
So it's all that analysis together, but my system rules, and if there's no signals coming up in that, then I'm not trading, and my exits rule too, because that's what tells me when to get out of the market. But if I'm seeing certain things displaying in the indices, this would probably be more prevalent with my daily trading system. I will take more action a lot quicker because it doesn't have as long a hold time. It probably averages about 30 days in a good trending market. It's probably been a bit shorter in this current volatile market. But I can switch sides very quickly with that system. And I can run a scan one week and getting a lot of strong long trades, and I could be trading that direction, and then it all changes the next week. So it's a lot more active.
Okay, cool.
And it will be bringing up a lot more signals, where that long-term system just was not bringing up any signals at all when we're in that downtrend. Okay, so moving on. What I want to do now is actually have a look at the market and charts of the markets. So what I've got, or before we do that, I want to provide some statistics. So just have a look at what's happened currently in the market, because August has certainly been a lot of market action out there in the world markets. And this is what happened. It all kicked off around the 5th of August, the 3rd of August was when I started to get some strong short signals up. Had a really big fall of the markets on the 5th of August, which was a Friday in Australia, which followed through on the Monday. But we pretty much in 5 trade days had 11% fall. And you'll see a copy of those charts shortly. The US markets in 5 trade days had a 13% fall. So that was a very powerful fall in 5 trade days. And to compare, the GFC, for example, I mean, while it had a few sharp falls, and I mean, whether we're moving into another market like this, in a 9-month period, the Aussie market fell 47%. The US market fell 52% in 9 months. So, I mean, basically half the market was wiped out in a 9-month period in the GFC, where it took a couple of years for it to rise that far. So, like they say, the saying is with the bear market, the bull's nice, slow and steady, but the bear jumps out the window.
Yeah.
So it happens a lot quicker. And also to compare, the other big drop that probably occurred in the last decade was the World Trade Center crash. That happened in September 2001, which we're building up to the anniversary of that period. The Aussie markets fell 9% in 4 trade days, and the US markets fell 12% in 5 trade days. So it's nearly similar activity to what's happened recently. Whether the same thing's going to play out, because the market did recover after the World Trade Center crash, and that was pure uncertainty and fear out there. I mean, that happened with a terrorist attack, and anytime there is uncertainty and fear of any kind, the market is affected. And at the moment, there's a lot of uncertainty and fear out there with the US debt ceiling, the rating downgrade, and now Europe. Problems in Europe. That's what's been affecting the market overnight last night, and probably could filter into the market into next week. So, there's a lot going on out there that's creating that fear and uncertainty and causing people to sell out of the market. Whether it's going to rebound strongly, which we have seen a rebound, and that's going to continue. Probably the best way to have a look at it is to go and have a look at the charts now. So what I've done is I've got a range of charts in here, so we can look at a long-term weekly time frame, so we can look at it in terms of those 4 market stages, and then we can hone in on some parts of the market and compare to what's happened currently and in the past. So on the screen is the XJO, which is a weekly chart of the ASX 200, which is the prime index in Australia, and it's got the 30-week moving average on there, and you can see from 2004 to 2007, the healthy stage 2 uptrend. That 30-week moving average line was predominantly rising, and the share price was above it, and you can see an uptrend line has developed. It eventually tops out, and when it breaks through that uptrend line, and the moving average line has rolled over, and the share price is going below it, we don't have much of a top phase that happens. We probably have a minor support area from the last low, and then it breaks down, and it has a short sharp fall at the beginning of 2008, recovers quite sharply, which is a similar pattern to what's been happening out there now, but it didn't hold itself, and it continued to fall sharply after that. So once it had its second fall, that's when in 9 months it wiped nearly half the market gains out of the stock market. So what took 3 years to build up in the bull market was wiped out in a 9-month period. So yeah, it was definitely fast and furious. But then it got to a point, and this is probably why we didn't move into a stage 1 base for too long, because it got to such low prices, people were buying in, and the market really started to recover mid-2009. So in mid-2009, the market bottomed out, started to rise back up, and then started to make new highs. And we have the 30-week moving average line rising and the share price above it. So the market started to become healthy, probably for about a year, and then it got to a certain point where it has been churning sideways now. So this could be called a stage 3 top, because it's had a short-term uptrend, not very long, not a long period of time, but for 18 months now it's been churning sideways. And the interesting thing is that the recent market action has pushed it below support. It has recovered back above it, so we're either in a similar pattern to the World Trade Center crash, where it's had that big dip of uncertainty and now it's going to recover and move back into that sideways trend, like a V reversal pattern, or maybe it's a dead cat bounce, which is where you have a big spike in the market, it recovers back up, but then you have the downtrend that commences after it. So as to whether it's going to do one or the other, I don't know. We'll be able to look back in a couple of months' time and know exactly what the market's done. But for me, I'm just trading the current action in the market and taking the signals that my system's providing, and having a bit of a fun ride, I can tell you, because the market's been not doing a whole lot of the last sort of 18 months. You felt like you're a scalper in the market, just taking what the market can give you, and then wham bam, we've had this big volatility ride. So let's hone in a bit more on the chart. So that's a long-term view of what's been happening out there. And if we have a look at the 3-year view, you can really see in Australia how the market has been going sideways from it rose to its high points up till end of 2009, and then beginning of 2010 it's pretty much been going sideways between these support and resistance zones. And with my daily system, I've probably been, I'll be trading one direction for a month, and the next time I'm trading in the other direction. And that's because, as you can see, it's risen up, it'll fall away, it'll rise back up, but it hasn't been able to get beyond the 5,000 mark. And now it's just pushed down through the support level that's built up in here. It has recovered back up, so it's going to be really interesting to see what continues to play out in the markets. Let's compare this now to, before we do, this is a zoomed in daily chart of the market. So you can see that drop, like you saw the weekly chart in the last slide, and you could see that it had broken through a support level. On the daily chart we had a support level around the 4,450, and then the next one, which you saw it break through on the weekly chart. And this is the 5 trade days that occurred from when it broke through support. So you got one where you actually got from where it broke through over here, and then it followed through with a big gap, another down day, another huge gap, and another big black candle before we get the recovery. And when you get a recovery, with candlesticks, anytime there is a large wick on a candle, and then the market closes at a higher price than it opened, that's showing a rejection of lower prices and is usually a very strong reversal pattern. So I had a very fun time for 5 days trading short. I aggressively exited out of my short trades when this occurred, and then I entered into the market long, because all of a sudden I had shares that were at yearly lows that I was able to pick up. And I'll show you some of those trades as we move on. So that's honed into the daily action that's occurred. Okay, so let's now just hone into some of the past market action. You've seen the GFC on the weekly chart, and whether something similar is playing out where we've had the recovery and it's going to start to trend down, I don't know, or we're going to have a similar thing to what happened with the World Trade Center crash. So with the World Trade Center crash, the market had a big drop. It was trending sideways currently, similar to what the market's been doing in the past, and then it broke through that support level and fell very heavily, and in 4 days 9% was taken off the market, 4 trade days. So 1, 2, 3, 4 had a slight recovery, fell again, and then it took off. And that's your V reversal that's occurred in here. And with a V reversal, that's usually a very sharp bottom reversal that then recovers. So we're either in a similar pattern to what's occurred here, or we're going to be moving into that downtrend because we have broken through support, and while we have had a recovery, it's a matter now of if it can't stay above support and it moves back below and starts trending below that moving average line, and that moving average line continues to fall, we are in that downtrend again. So we're at basically a stage in the market where there's a big change coming in one way or the other. So it's really going to be interesting to watch.
Which is a good thing for traders, because it's easier when that market is trending rather than just sideways, even though there are different strategies that you can take advantage of those sideways movements, but you really like it when it's powering one direction or the other.
I mean, it's much easier to trade when you have a clear trend. The big winners are available, the market's moving nicely. When we have those sideways markets, I mean, my expression is you feel like a scalper. You're basically just taking what the market will give you and then it all reverses. And, one of the strategies which I've talked about with the Mastermind members is, during certain market times you might tone things back, halve your risk in the market, and that means your position sizing. If you usually enter at, say, a 2% risk in the market, you've got a position sizing strategy of 2% risk, you might halve that down to 1. Or if it's 1%, you might halve it down to 0.5%. And halve your heat levels. Portfolio heat is a strategy that I use for my maximum open market risk in the market. So I know at any point in time my worst case scenario. So when the market has a big change, I haven't taken on board too many trades initially that I have risk open on. And when I talk about risk, that's when you first open a trade. The riskiest part of that trade is when you enter it, because if it doesn't go your way after you enter, you will take a loss on it. Ideally it will go your way and your stop loss will move up and become favourable, and then you'll lock in a break-even trade. So once your stop has moved to break-even, you've got a no-loss trade on. So I'll only have no more than 5 trades open initially, and I can't open up any more till they start to become favourable. So I'm always controlling my total open market risk. And this is all from my experience during the World Trade Center crash, because I had just started trading the stock market full-time in 2001. It was a hobby before that. I was doing it part-time as well as having a full-time job. And then in end of 2000, my husband and I decided, well, let's give it a go. Let's see if I can trade the markets full-time, so that I had something I could be doing at home when I have children. And we are investors. We invest in property as well. And we wanted to have that cash flow coming in, because you don't get that cash flow with property. You've got to wait for capital growth, where you've got that liquidity in the stock market where you can sell out in and out of things very quickly. So we like that idea of being in control of our finances. So 2001, I kicked it off, trading the stock market full time, doing all range of different strategies. Doing quite well, also learning a lot about myself, but I can tell you I learnt the most in this drop of the World Trade Center crash, because I was overexposed, too many positions open, ego was too big because I'd had a nice ride and I thought I was invincible. But it only takes something like the World Trade Center crash or a drop like we've had in the market currently to show you that you're not invincible. Basically wiped out all my profits plus some on that one-day drop, because I was trading very short-term with options with high-risk strategies that I would not even touch now, and no portfolio heat. So it was a huge learning curve. I sat out of the market for a month after that, and I just watched. I didn't even know if I was going to go back and trade, because I was took me, I think, the first week to recover from what just happened. Realization of what did I do wrong, what could have I done differently, and then really looked at, did some courses very strongly in the money management side of things, and realized I had no portfolio heat. I was position sizing trades, but I was opening too many of them. So I changed everything, and my whole strategy changed. And in 2002, that's when my daily system developed. I was already trading my weekly long-term system with my self-managed super fund, so that had been running very nicely in the background, but I really honed in on the daily system and really brought into play some key core money management rules, because that realisation of you've got no control over the stock market. The only control you have is how you manage your money in the market, and having that clear, concise trading plan. And I wrote, if this happened again, what would I do differently? First of all, I'd have heat available in the market, So I wouldn't be overexposed, so I would manage that worst case downside. But being through the GFC, the signs were in the market, and I was trading short when the drop happened, so I was comfortably set up. And just recently, with the current market action, the short trade started showing in my system on the Wednesday, and the big drop happened on the Friday. So I had 3 short trades open before the big drop and added another one. So I was trading short at that time already, and profited during that drop.
I think the real key thing here, like especially for someone who's listening to this, they might be in a situation where they've just suffered some big losses and they've got that feeling it might be their wake-up call, just like it was for you back then. It's like that turning point where they can realise, hang on, I don't have a proper strategy, a trading plan in place, and this might be the point where you make the decision and you go, no, I'm going to change the way I'm doing things, and I'm going to make sure that I've got everything set up perfectly so I can start to trade all market conditions, and I can, survive and prosper in these times as well. So maybe it's a wake-up call for some people. It could be a good thing.
Certainly is, and in part of all the course, my main course that I teach with my trading systems, I talk about you need to have a market exposure strategy as part of your trading plan, and this is my exposure guidelines. What would you do in a stage 1 base? How would you trade that? What would you do in a stage 2 uptrend? How would you trade that? And so on. And having a strategy for the different kinds of markets, and then when unforeseen things happen like this, what would you do differently?
To build one last thing I want to add on that as well, it's funny hearing this get echoed through you as well. We had an interview with Daryl Guppy a while ago, and I think one of the biggest takeaways and a lot of the comments that people had made was that he had commented this idea of having a different trading plan or a different system to trade different types of markets and then mixing it up. And the biggest question people kept on having was how do I know what stage the market is at so that I can start to go, well, what type of trading should I be looking at? So I think it's great to see those market stages that you showed us early on in this presentation. And I mean, that helps sort of lead someone to the direction of figuring out, well, what market are we in now? And then make sure that you've got a trading plan that's matching the appropriate conditions.
That's right. And make that part of your weekly routine. Review the indices, the index charts as part of your weekly routine. And I also say review the sector charts, because within those, within the stock market of every stock market around the world, you've got the 12 GIC sectors, the global industry classifications, and you can go and also look at the charts of the major sectors of materials, industrials, financials, and so on. So you can view them in exactly the same way, because you might have one sector that's outperforming while the others are doing what the main market's doing. Okay, so let's now hone into the US market and see what the US market's doing. This is the S&P 500 in a weekly chart. You can see the health of the market during the 2004 right up through to 2007, and it started top out in 2007. You can really see a sideways trend developing in the US market where it double topped and it built up resistance, and it built up some support level in there. And once it broke through that support level and also the uptrend line, that's when you had the sharp fall start in January 2008. The recovery came, but it didn't stay there, and it fell very heavily. And then it fell to certain price points. I mean, it fell 52% in 9 months, so it wiped off 3 years worth of gains in less than a year. Recovered quite sharply, and once it broke through this support level over here and started making higher highs, that's when we had a healthy market developing again. So it did come off a little bit, and it hasn't been, it's been a little bit volatile in periods during this market, and it started to come off a little bit in mid-2010. But unlike the Australian market, which then went sideways from here, the US markets have continued to trend very strongly. So they actually made higher highs, and there's been some phenomenal trades on the upside in the US markets. But just recently they've come off, and you can see the US market has started to get some resistance and having difficulty making higher highs for the most part of this year. and it even built up some support, which it has broken through, and it's also broken through its uptrend line. So at the moment, the health of the markets is not looking very good. It has fallen very heavily, and that's why short selling should be an important part of your strategy if you are a trader. An investor might be different because they trade longer term, but for a trader that's more active in the market, this is the period that you'd be short selling through.
I wonder if that recent rise was, especially when seeing what happened in the Australian stock market, could have something to do with the stimulus package finally coming through. Like, I mean, they pumped so much money into their economy, yet the fundamentals were still rather shaky. So it's, I mean, I suppose as a technical analyst, you don't really need to worry about why, but you look at what happens.
And you could also say with the Australian market, our dollar has been very strong against the US dollar, which has affected our retailers and our exporters, and has, I mean, the businesses out there that are affected by that have not been performing as well. So that could have had an effect on the Australian market not being able to move to new highs like the US market. So there's plenty of economic indicators that you could hone in on. But yeah, from a technical perspective, it's just the charts, and in the end it doesn't really matter what the reasons are. This is how it's trending, and you just need to have a strategy as to how you're going to trade it.
Yep.
And let's hone in on that weekly chart a bit more. This is a 3E chart of the US market, and you can see it's been channeling in an upward channel very nicely from about mid-2009, and making those, the uptrend line's been rising and the highs have been getting higher, and just seeing recently now how it's broken below that upward channel line, and that's usually quite a strong signal of a change in trend. So it's going to be really interesting to see what plays out in the market now, because if it's going to continue to downtrend, but we're going to see it fall, it might come back and get a little bit of resistance, and then it will fall away if it's going to continue a downtrend. But if it does get back up within that channel area and continues trending in there, then we've just had a blip or a V reversal that's spiked outside of it. So I can't tell you for sure what it's going to do. I just trade the signals. But I know that there's obviously a big turning point that has occurred recently. And this is a daily chart of the recent market drop in the US market. So we can see it had built up that support area around here where I've got the line on the chart. It fell to that support area, tried to stay above it, but then it broke through and fell very heavily through support and also through the bottom of that channel line. Started to recover, and then in the US it's had another major fall. So it's now going to be interesting to see if it takes out the lows now, because if it does make lower lows now, that's going to confirm that the market is now trending down. If it makes any form of equal lows, then it could just start going sideways, but it's really in a market change that's occurring right now. And to have a look at some of the other market action, this was the World Trade Center crash in the US market. So you've seen the GFC in the previous chart, and the US market, like Australia, had been going sideways and probably was falling, because this is a weekly chart, so you can it's a daily chart. So the market was falling, and then when it broke through support, it had a very strong spike, and it fell 12% in 5 trade days, but it ended up recovering. It actually got back up to the support that it broke through, got a little bit of resistance, and had a bit of trouble for about a month before it then started making some new highs and trending again.
It's amazing to see how much volatility now is in the market. Like, I mean, when you go back and you look historically, I never used to see such strong V reversals like that, looking historically. Like, it feels like that volatility is so high, the market doesn't know what it thinks it's doing.
That's right, and that's why we're at a big turning point.
Yeah.
And this is probably why this webinar is so timely.
Yeah.
And I probably had the most action that I've had in the market for a while. When I saw my scan, my scan was bringing out 30% of the stocks were making new lows on the Wednesday when we had the break on the Friday. So we started to get some really strong market falls occurring before the follow through came.
Yeah.
And if you were active like myself, you would have seen that occurring, because I just run my scans, and because I trade on the long and the short side of my daily system, the strength on the short side was very strong. So I knew that I could feel the change in the market. I could see the strength there, and I could see the opportunities, and there was a lot of them.
Yeah.
So let's just summarise a bit of what's happened out there. I mean, 2011 has been a challenging trading year for many people. I mean, we've had the ASX market churning sideways for most of the year, and now it's just had a strong break on the downside. The S&P 500 has been making new highs and was trending upwards, but started to falter, and now it's collapsed. And it's even broken below that channel line that we just saw. And with everything that's happening out there, I mean, market confidence has definitely fallen strongly in the last few weeks, and the sellers have dominated. So any form of uncertainty in the market, that drives fear into the market. And it was only a couple of years ago we had the GFC. So we had the global financial crisis in 2008, and now with all the US and the European debt issues that are going on, I mean, that's creating some uncertainty. Things might not have changed fundamentally with businesses themselves, but it doesn't matter. I mean, if there's uncertainty out there, people freak out, basically. And then in Australia, as we talked about briefly before, we've had a high Aussie dollar, which has been affecting, our retailers and our exporters, and also a carbon tax thrown in there as well. So there's, a lot of economic things going on. But aside all that, you can see how you don't necessarily need to hone in on exactly what's driving it. If you're seeing the break in the charts, and it's taking action on that, and there's always going to be reasons why they can find what's causing it to happen. So and what we're seeing is basically a lot of shares recovered since the GFC, and but just recently, in August, we've seen some of those shares now back down to 1 and 2 year lows, which happened within a very short period of time, and that's all due to market uncertainty out there. And you can see the breaks technically in the charts as well. There's also been some nice buying opportunities that have occurred, and we're now either in a dead cat bounce, which is where we're going to bounce from this and move back into the sideways phase, or it's a dead cat bounce is where we bounce, but then we start to trend down. So it looks like the market's going to recover, but then it continues its downtrend. Or a V reversal is where we get the recovery and it moves back into its sideways phase. So your World Trade Center crash was your V reversal pattern. Your dead cat bounce is your global financial crisis. You have that sharp fall. You have a short-term recovery because the market falls quite shortly and sharply, but then it starts to make lower lows again. So we're at a point where either of those could be playing out right now.
Yeah.
And the volatility is very extreme. So if you're not confident and comfortable, I mean, this type of trading is not for the faint-hearted. I mean, you don't have to be trading through this. I mean, I took a break from the World Trade Center crash, and I sat back and I just watched and learnt. And, and that might be the point that you're at right now. So you don't have to trade everything. If you're not confident, take a step back. Hone your trading plan, or if you don't have a trading plan, start writing one now, because every trader should have a trading plan, because they're putting money at risk in the market. Let's now hone in on a few actual stocks. So we've had a look at the index charts. Let's see what some of the top stocks in Australia and also America have been doing out there, so that we can also see what patterns have developed in them. So the first chart I've got on the screen here is BHP. BHP has, over the years churned around between about $20 and $50. So it had a sharp rise in 2007 from $20 right up to near $50 before falling, rising back up, and then falling quite strongly through the GFC. And then it recovered back up slowly and steadily, and eventually back up to $50. And it's built up support level around here at this point, which is just under $36, which in the recent market fall has pushed it back down to this support level. So what's interesting with this one is, will it now bounce back up to $50? Because it is holding support. So it has this is a sort of strategy with a shorter term system where you would end up short selling and then you might become a buyer again. But it's going to be interesting to see what plays out in the market, because if we do get that recovery, you're likely to see BHP could possibly go back up to $50. But if the market continues to make new lows, you might see it break back through this support level. But at the moment, it's at new yearly lows. The next chart's Rio Tinto. Looks very similar to BHP, where, Rio's traded from $130 to as low as $25. So during the GFC, it fell from $130 down to nearly $20. So that's why you saw BHP more than halve in value. This is a lot bigger drop than that. And it has recovered. It hasn't got up to its highs like BHP did. It's managed to get as high as just under $90, and it has fallen recently and is probably at yearly lows now. So it's had a big wick that's fallen to that support level. But at the moment, it is trending sideways. Moving on to maybe one of the banks, Commonwealth Bank I've got here. You can see the health in the market, and then the GFC that occurred in here. The long pause sideways before another major drop. So we've got this shares traded from as high as $60 down to as low as about $22, $23, and then it recovered very sharply up to its highs again. And then it's fallen, and it's been churning sideways now for a period of 18 months, like the major stock market. And it did dip below that support level just recently with the drop. It's managed to get back up. It has also paid out a dividend, which has caused it to fall a little bit, but it has managed to get back up, and it's going to be interesting to see whether it can hold this support, because if it doesn't hold support and it starts trending below it, then we've got that downtrend in place. So it's showing an interesting pattern there. Moving on, here's another bank, ANZ, identical, similar, but it's a bit like BHP and Rio. BHP's got up to its all-time highs like Commonwealth Bank, but Rio hasn't. So ANZ is similar to Rio, where we've seen it. Its all-time highs have been about $32. It's more than halved in value down to $11. Recovered, but not recovered to its highs, and it's been churning around sideways now for nearly 2 years, and just recently broke through support level of $20. So I love it when I see support and resistance at round numbers. So pushed through $20 with the market drop, has managed to get back above it, but it's going to be interesting to see whether it can hold it or not. But if it falls back below it, then we've definitely got a downtrend that this stock's moved into. AMP is the next one. AMP really hasn't had a strong recovery. It's fallen quite heavily in the GFC. It's gone from $11 right down to below $4. Recovered to about $7, and has been churning sideways, fallen again, and is now at its all-time low prices. So the recent market falls has pushed it down to new lows. So it's really going to be interesting to see whether it can hold support here. It's had a nice bounce, which shows a nice buying opportunity. And it's going to be interesting to see if it holds this support level, then that's a good sign for the stock. If it doesn't, then we've basically got more downside to come on it. Okay.
It's pretty amazing to see.
So
I think all of those charts that you've brought up, they're all at significant points. I know we looked at the indices as well, but all of the charts, they're all right on their support lines and bouncing, like either they've just sort of fell through and then bounced back up. We're at a point right now, like you said, where the market is going to be moving, and it's kind of, which direction will it go, but we're at a significant turning point.
That's right. And here's another one. This is Wesfarmers, and this share moved down to the support level as well. So you've got lots of shares that have come down to yearly and 2 yearly lows that are bouncing off support levels. So it's either a good buying time again, or we're in for a major break. So and that I don't know. So I've sort of gone from trading short over 5 trade days to reversing the order, and I'm very vigilant with my stops now. Taken on some long trades because I've got some nice bounces of support, but I really don't know whether they're going to be long lasting or not. But from a technical standpoint, there are some strong bounces off support lines, but also knowing from the index charts we've got some key breaks that have occurred in the markets too. So that's why it's so timely, this webinar, because it's really going to be interesting to see what plays out and in the market.
Yeah.
So let's now have a look at the US market. So there's some key Australian stocks that you've seen. I've selected a few top US stocks so we can see how they've played out. And some have had some strong trends and some haven't at all. So this is Walmart. Walmart's probably, it's been in an upward channel, but it's quite a wide trading channel, and it's probably been quite volatile moving between this. So it's the sort of one that would be difficult to trade. You could trade it and get some nice runs on here, but it's one that you'd be, reversing, short selling, being a buyer and then also being a short seller. But it's also come down to the bottom of its channel line. So with a nice bounce up on it at the moment. And with there was a dramatic market fall that occurred overnight in the US, but Walmart's actually bounced and had a strong up day. So it's going to be interesting to see what plays out, because it's at the bottom of its channel line. Microsoft's been churning sideways for quite a long time, and it's at the bottom of its channel line as well. So similar thing occurring there. Pfizer, you've got it in an upward channel. It's had some nice strong rises in here, fallen back, another nice strong rise, and now it's fallen back to the bottom of its upward channel as well. So you can see how a lot of these shares have come off. Walt Disney, it's had a beautiful rise. It's doubled in price since the market recovery. Had fallen as low as $14, gotten back as high as $45, but it's now broken its uptrend line, and it's now sitting right on a support level, which it's tested in the past many times before. So it's at a significant point now where it's had a breakdown, and if it holds $31, we might see it go sideways. But if it breaks through that support level, at the moment it's showing signs of being in a downtrend, because that moving average line is curling over and the share price is trading below it. So it has had a major break recently. But then there's been a few standout stocks out there, particularly the Big Mac and the iPad. So people are obviously out there still buying their Big Macs, because this is McDonald's. So it's been trending very strongly. So yeah, it wasn't as affected that much by the GFC. So maybe, people like to eat their Big Macs when they're feeling not so well, when they're depressed. So I don't know, but it didn't have that heavy drop like other stocks did in the GFC. And when the markets did become healthy, it took out its highs, and it's got as high as $90, and it hasn't broken anything even with the current market drop. And we're hearing about the iPad in the news all the time. So Apple has been performing phenomenally well and is still rising, and that moving average line is still rising. The share price is still above it. So it's interesting to see how you have a series of stocks that are all breaking down or at bottoms of channel lines and at low points, yearly lows, and then you have other stocks that just haven't been affected. And that's what happens out there in the market. You will have some stocks that then not every stock's going to be doing the same thing. You'll have a few key stocks that will buck the trend. Okay, so one of the things by looking at the current market and what's been happening and understanding those market stages is what we talked about before, having a market exposure guideline for the market. And when I talk about market exposure, there's a few key things you need to pre-plan for, because you're going to have money management rules and exit strategies, but there might be a few different things that you do in different markets, like what you're talking about before, David, how you had that call with Daryl Guppy. I don't change my actual systems. I still run my trading systems in all markets. I may refine a few things and cut back my exposure in the market. And that's pretty much what I do in certain kinds of markets. So some of the things that you need to ask yourself when you plan is, what will you do if you hit that cluster of losses? And that usually happens if the market has changed, and you may have hit a cluster of losses with what's just happened out there. Or maybe you haven't been trading with a clear and concise trading plan or trading rules, and you really don't know what you're doing. A cluster of losses is telling you to take some time out, take a step back. Something's not working. So that's a sign straight away that things need to change. So you need to decide what you're going to do when you hit that cluster of losses. What are you going to do when certain things happen in your life where you can't be focused on trading? I mean, there's a lot going on in the market, and you might say this is a difficult market. So if you're finding it difficult, you need to take a break from trading. If things are going on in your life, you shouldn't be exposing yourself to the market either, because if you can't be vigilant, especially if you're a trader, a long-term investor may stay invested through certain periods, but if you can't be focused on the market, then you also need a strategy of what you're going to do. You know, if certain things are happening, maybe you're moving house, you've got a baby coming along, something's happened in the family, somebody's not well, you need to pre-plan for that as well, and how you're going to act with your trading. What will you do when you go on holidays? For me, it depends how long I'm going away for as to what I'll do. And most importantly, what will you do with the different kinds of market trends? So these are the sorts of things you need to consider as part of your market exposure guidelines. And I've really been focusing on the last part of the market trends in this webinar. So we'll just talk a little bit about each of these things. Firstly, you're the most important part of your trading. You need to take responsibility of you. So when you open a trade, one or two things are going to happen. It's either going to be profitable or it's not. And unfortunately, not every trade is going to be profitable. That's just part of the game of trading. You're going to have to take losses. But as long as you minimise those losses and keep those profits big, you will be profitable in the market. It's the traders that fail that don't control those losses. But if those losses are bigger than your winners, you're not going to be profitable in the market. There's just no way. That's why you need to have money management rules that make sure your losses are always smaller than your winners. And, you know, when you hit that cluster of losses, at what point are you going to stop trading? Are you going to take time out to reevaluate your trading and your psychology as well? Because once you put real money in the market, your emotional intensity goes up. That's for sure. Paper trading really doesn't bring any of that into play. It's not until you really put money in the market that you realise it's a different intensity out there. But you need to decide, you know, what you're going to do. I mean, tone back your exposure and even stop trading and reassess what's gone wrong. What am I doing? And have a look at your trading plan. I mean, maybe you don't even have a plan. You need to have a trading plan in order to become a successful trader.
What do you count as a cluster? Will get refined. Oh, sorry. What do you count as a cluster? Yeah.
I'd say, well, it depends how active you are in the market, but for a shorter term trade, that would probably be 10 losses in a row.
Yeah.
So with my market exposure, I can only open up 5 trades initially, and potentially those 5 trades could go against me. So if that happened twice, you know, that's a cluster. So,
yeah.
But it depends how active you are. A longer term trader, I mean, it would take a long time to hit 10.
Yeah.
But yeah, for a longer term trader, a cluster of losses mean all of a sudden a whole lot of trades just, your exits just get hit and you haven't made any money on your new trades. That's telling you a change has just happened. So yeah, so it's giving you a signal of some form to say a change is happening. Either you need to change because your trading needs to change, or maybe a change has happened in the market that you don't know how to trade or need to take different action on, or do something differently. So that's what you really need to stop and reevaluate everything.
Yep, cool.
And so that's why it's so important to take that time out. You know, evaluate yourself as a trader. You know, what went wrong? You know, did you follow your plan? Did you exit when you should have exited? Did your losses get out of control? I mean, what did you do wrong? Or maybe you didn't have a strategy. What needs to change so this doesn't happen again? I mean, you're going to learn the most from the market by learning from your mistakes, basically. And then, you know, once you've worked it out, how do you go back into the market from there? You need to re-enter slowly. I usually say halve your position size and move back in slowly and build your confidence up again. So, because you've got to become confident in order to basically continue to build up and become that successful trader. You don't want to be running on adrenaline where you take the losses, you get out, and then all of a sudden you go powering back into the market. You might just, the same thing may just happen again. You've really got to go back in with that clear strategy and build that confidence back up in the market again. And have a different strategy of what you're going to do in the different kinds of markets. I mean, the stage 1 base and the stage 3 top are the difficult markets to trade. And for me, I've got an aggressive exit strategy that I bring into play. My entries rules don't change, and my trading systems, I still run the scans, but my exit and my money management get tightened up, and I do things differently. So I'm more conservative, and I tone my exposure back by halving my risk and my heat levels. Stage 2 uptrend, fantastic. You know, I'm just running my systems, I'm trading with the trends, I'm letting my stop losses tell me when to get out. This is where the big money is going to be made. You get into that top phase again, a difficult part of the market to trade, and this is where you'll find if you are long, your exits get hit, and then you'll end up getting short signals. So you have to be able to reverse or know when to stop trading. Stage 4 downtrend for me, another great trend to be trading. We've got a market trending, we've got a market falling. I'm a short seller. I'm profiting from falling shares, and just letting the market tell me when to exit with my stop losses. So always trailing that stop losses on my trades. I do have other things that will tell me when to tighten things up or sell half and take some profits, or aggressively exit if certain things occur. But most of the time in those trending markets, I'm just trailing my stop and exiting once those stops are hit. And then once again, stage 1 base. I mean, you know, what are you going to do differently to what you would do in a trending market? So you need to have rules in your plan around that. And I've really been focusing on those core key topics over the last year and a half with my Mastermind members, and showing them what I've been doing differently, and sharing my aggressive exit strategy, and sharing my trades and so on. So that's what you need to have a plan for, as well as part of your market exposure guidelines. And as I mentioned before, I mean, you're the most important part of your trading, because it's all about you and your money in the market, and it's your decisions and what you do in the market that makes you successful. So the best way to take the emotional intensity out of it is to have a plan, and have a plan for everything that can happen in the market and your life, and how you're going to handle it. So let's move on to some real trades. We're getting to the end of the webinar now, and as you can see, I've had a lot to share because a lot has happened. So with the real trading, I've got a few current examples, and these are more volatility trades that I've been doing in the market drop. My trend trading and things I'll talk about next. I'm going to run another webinar with David and really show trades that I would normally do with my system in a normal market, and how things play out, and what I do with them. But these ones are my volatility style of trades. And when the market had its sharp fall just recently at the beginning of August, and I ran my scan in the market and started to see some market breaks like this one, I became a short seller. So what I'm seeing here is the market was rising, it's had a gap down, it's fallen quite heavily, and then it's moved to new lows basically. But I entered on that break of that uptrend line with the gap down, and entered short here, and I wrote it down for 5 days, or 7 days in total if you count the weekends. 7 days I held it for, and once we had this strong rebound, I aggressively exited and took my profits on that trade, because I could see that there was a strong reversal happening. And this is part of my aggressive exit strategy, which I only employ during these times. We've had a sharp fall, I get any sign of a strong rebound, I aggressively exit and take profits. In a normal trending market, these things don't happen. So I've taken action on that trade, and I've held that trade for a total of 7 days. It was 11% return on the total trade size, and this was actually a CFD trade, because that's what I short sell with in the market, is CFDs. So it was 140% on the margin outlay, which was 8% margin on this particular stock. And you can see that this share has recovered very strongly since then, and you would have been taken out with a stop on that. But it was such a beautiful break and a gap through that trend line, and that's what I'm looking for to short sell. And this was another one I picked up on the same day. So both these shares came up in my scan on the 3rd of August. QBE, this share had clearly been trending sideways for a period of time, and it gapped with a nice red candle, clear break. I entered short in that one, and it fell very sharply with a big gap in there, and then it started to display that reversal candle with the big wick, and closing up near it, closing up for the day. So I took profits on that day and exited out of it. It did rise up. It has actually fallen back down a little bit. It hasn't looked the same as Amcor, but my strategy was to take profits, because the fall was very sharp and very fast. And when I see that happen, you can either sell half or you can exit entirely. So there's times when I'll sell half, and there's other times when I'll exit entirely. And the reason why I exit entirely on these trades is because the entire market had fallen so heavily so quickly, and the index was showing such a strong bounce. And I started to see some long trades I wanted to buy into on that day. So I pretty much went from short to long on that day. Here's another trade. This was ANZ Bank. It actually broke the day before. I did see it on the 3rd of August come up, and I entered it the next day. I'd already taken on 2 trades on the 3rd of August with the 2 you just saw, and I entered into this one the next trade day. Nice candle breaking down. Well, it gapped very strongly the next day, fell very heavily, and then we have the reversal. This, in candlestick terms, this is called an engulfing bull, I should say, where you have a white candle, or in my case I've got them coloured green, where you have a green candle engulfing the down candle, the red candle from the day before, and that's usually a strong reversal pattern, and I took profits on that trade, and it has since bounced up. I actually reversed on this trade and then went long, so I've gone from being short to long, and that's how quick the market action has happened recently. This is not my normal trading, and when we're in a trending market, what you would be doing, but this is when you can make some quick money fast. But it's not for the faint-hearted. It's not for everyone.
I feel like the key lesson there, the takeaway, is there's absolutely no way someone could trade this style of trading without having a trading plan in place. Because to react that quickly, if you needed to be sitting there trying to make decisions on, where you're going to set your stops and what's going to be your entry, that type of stuff, you need to have pre-thought that out. So when the time comes, you're reacting to what the market is doing based on those predefined rules rather than figuring out it as you go. So particularly to profit in these times, you must be trading with a trading plan.
And for me, the short selling basically was just because my system, when I ran the scan that those couple of days, was bringing up phenomenally strong signals on the short side, and I got stopped out of my last long trade. So I could see the change had happened. So I didn't do anything different with my entries. My entry system was exactly the same. I was just more aggressive with the exits, and that's where, realizing when certain things happen, you may take profits differently to what you would do in a normal trending market.
Very cool.
And on the chart, on the screen here, we have an open trade that I undertook. So this was one that had fallen very heavily. I didn't short sell this one, but once it fell to its 52-week lows and rebounded off that support line and had that engulfing bullish looking candle, I became a buyer in here and bought into this stock. So I've gone very quickly from one side to the other side, and and that is from that experience. And as you said, David, having those extra rules in your plan as to how you handle. For me, I call these windfall profits and sharp price movements, and what you will do in those situations.
Yeah, I love it.
And no matter what I buy, I will always have a trailing stop line that I put onto the charts, and that rules. But I may aggressively exit, especially in these sort of moves, before that stop gets hit. In normal trading markets, I'm just trailing the stop and letting the stop tell me when to get out. So, and I've got a great video. I'll give you a link to the video. I created a video for my clients of the recent market action to show you my market scans and just the difference of how many short trades were coming up before the big market fall. And you can really see how I put my systems into play, how it's all computerized, and how I run the scans. So we might put a link up to that video, because that shows a really good video of what I've just done recently in the market, and I showcase those trades that I've just put here on the screen.
I think from the last time that we launched the OTM, one of the most popular sessions was a session where you actually walked through what you do for your trading, and we talked about, okay, we run a scan, you've got those preset conditions. So I think actually seeing it real live and seeing it, okay, here's what's happening in the market at the moment and what was in the lead up to that'd be great. So I'll definitely follow you up for that link, Justine.
Yep. Great. Okay.
Well, I suppose that brings us to the
so have you got some
end.
questions?
Well, I think the main thing for me, like, I just wanted to sort of capture you sort of as we went through the different sessions, or the different slides. I grabbed any that sort of popped up. I know some of the people watching this are going to have questions, and once I email it out to everyone, definitely we're planning on having another couple of webinars following this as well. Like, this is part of the relaunch for the online trading mastermind. I know there are a lot of people who missed out last time, and like I said, we hadn't opened it up for well over 12 months, so we want to really show you in the lead up to opening it up again that Justine knows her stuff inside and out, and this is someone that you need to be taking notice of. So if you've got any questions or anything like that, when I send you this link, just make sure that you reply back if you've got particular questions, and we'll work it into the next webinar for you, and I'll be the advocate for you and make sure I get the answers that you're looking for, to, I suppose, really just properly understand what it takes to be a professional trader. I think that's where Justine steps out above the crowd from a lot of different traders out there, having the right licensing, having the guts to showcase the trades of here's what I'm taking, here's where I entered, and I know inside the mastermind as well, Justine, we've talked about quite a lot of those winning trading opportunities as well, but Justine reveals all. You actually see the trades she's taking, what the annual return was, good and the bad and the ugly, so you really get to see all of it. I know we've got the next webinar that we sort of just started planning out, where I want to find out a little bit more about Justine's actual trading approach, and I think that'll link in well, Justine, with that video that you mentioned, and like we'll have a look. You've got there some of the things we'll look at, the best and the worst trades of last tax year, for the Australian financial tax year, which again, it's showing you those trades. Not every trade is going to go in the right direction, but it really shows and reinforces this idea of this importance of having a trading plan, and we'll cover that. And then obviously any questions that you guys have, guys and girls, as you're watching this, just make sure that you send them through. I'm here on your side, making sure I've got Justine committed to another couple of webinars, so we can ask her anything we want. So just email that through, and I'll make sure I'll work it in. So we might wrap it up there, Justine. Thank you so much for your time. I know incredibly busy.
That's all right.
And really just happy to get back on it with you. Like I said, we've been working sort of pretty closely with those mastermind members, and they've been getting some great results, and really keen to open it up again and get some new people in there, particularly in this market. It is so timely. If you remember what Justine was saying, this idea that for her turning point was almost the market conditions we're experiencing right now. So if you're listening to this and you've got that feeling like, yep, enough is enough, I've seen the market collapse like it did, and whether or not some of your profits, or even worse, some of your trading capital got eroded away, now's the time to go, no, I need to get a trading plan in place. We're going to have lots of more free videos coming on over at the Online Trading Mastermind. You can see the URL there on the screen. Definitely go check it over there, and keep an eye out for the emails that I'll send through, because I'll just send through the links once we get these webinars up and running. So again, Justine, thank you for your time, and look forward to the next session.
Thank you, David. I look forward to sharing again.